All right, guys. So as I speak, um, S&P futures are down about 77 points. So that takes us right now. We close at 69.40 on Friday. So we're down at around this area, down right around 68, like 75-ish, roughly, somewhere around here. Um, that possibly leads the way down toward this low of 6,700, which I mentioned a few days ago. I think it's possible we drop down toward 6,500. The whole, rhetoric now from the White House is that basically they want Greenland and they're willing to do whatever it takes. But at the same time, I have my own views on this, which are that we've seen this happen before back in April, the Liberation Day, and how fast we declined. If we analyze what happened here, I mean, we dropped 21% in the span of, one second, my screen is cut off. So from basically from February 20th until the low of April 7th. So in about a month and a half, roughly. So if we extrapolate what happened there to what could happen here, it's possible that we fall into the February slash like early March OPEX. I won't say March OPEX, that's about 2 months away roughly, but if you fall down, we could fall easily 10%, and 10% from where we're at right now, let's mark from the high, takes us down to 6,300 or so. So that's why I was mentioning to build out hedges because again, like with these headlines coming out recurringly, you have no idea what's going to be said and how the market will react. But we're already seeing natural gas futures spike. Commodity prices are spiking as well. Gold and silver, copper. That's not overall bullish for the market. And if this continues with Greenland, where NATO nations are ostracized for taking a proper firm stance as they should, basically that could end up in Europe dumping U.S. debt at some point, which would cause interest rates to spike pretty heavily. Now that's just pure speculation. Now, how do we play this going forward? I want to think about this from the perspective of how am I positioned right now and how do I want to hedge myself? If I'm looking at, for example, taking out hedges after we already decline, on the first decline, it might be a bit more expensive. If we keep on falling, that's where if you don't build your hedges out soon enough, it might be too late at a certain point because you don't want to be buying hedges when we're down at like 6,700 or 6,500, for example. You want to be building them more at all-time highs when volatility is very low. And I mentioned last week, selling the 7,100, 7,150 to finance the 6,850, 6,750. That was basically a debit of like $3. That could pay as high as 97 or so, right? Um, Also, we got to factor in that it's possible that you know this gets reversed pretty quickly as the market falls, and the White House doesn't like watching the market fall, and we see some pullback on their stance overall, right? That could cause a fast rubber band pull to the downside and a snap back up to new all-time highs. So you got to factor that in as well, right? But thinking about this from the perspective of in the first half of this year, we should have a drawdown of 10 to 20% based on historical midterm election years. The reason why I think it'll happen in the first half of the year is because in the back half of the year, we'll probably see more of a rally, as we usually do in the latter half of the year, toward new all-time highs. So it's possible we see it, as low as 6,000 perhaps this year, and then a new high of 7,500 as well. And how do we want to position ourselves? Well, the great way to do that is playing risk reversals when the IV spikes on pullback. So, for example, let's say like a name like Elf, which might be a huge benefactor if the Supreme Court rolls back Trump tariffs. We can see what happened when these tariffs came about on the 5-year chart. We basically fell down from 150 all the way down to
Oh,
$50 on the Liberation Day news. So I'm not saying to buy Elf necessarily, but you got to look at names that have been beat up heavily on tariff news. Elf was one of them, right? So if the Supreme Court rolls back tariffs, it's possible we see a move kind of like this, the upside of 50, 60% in the span of a couple of weeks. So finding asymmetric plays like that would make a lot of sense. Again, you need to have liquidity in the option chain, obviously. Someone mentioned they wanted to look at Aapl as well. So Aapl is interesting because they have a lot of products coming out this year. They're trading right now on this trend line, and they're kind of sitting right near the support area. If we break down further, then that possibly creates a window to go low as perhaps 230 or 225. That would entail, or a market correction would cause this to happen probably, right? Beyond that, a bounce back up to 280 or so on, again, rollback of Trump tariffs would possibly cause a push back up to 280, back near all-time highs, roughly. So strategizing going forward, looking at actual strategies, if we pull up an option chain and look at how we can structure positions, and again, given that we've already moved about 80 points on S&P, these won't be absolutely accurate in terms of like what you can do right now, but let me change my screen right here. But let's say, for example, that you want to structure a position on the February OPEX, which is only about a month away. The 20th is the actual Friday. You could still sell out of the money call options if you wanted to finance the put side, but keep in mind with the IV spike or the big spike, it won't be as favorable, right? Because when the big spikes, the skew favors put side typically, right? So looking at this, let's say we sold, for example, the 6,700, I mean, sorry, 7,000, 7,000 half overall, and we use that to finance, for example, a 6,800 perhaps, 6,700, something like that, right? The cost there is five-ish to make 95. But obviously tomorrow we're going to open down about 80 points, assuming that Peter's hold. And this will probably inflate to about 15, risk to make 85 or something like that. So again, structuring around this is very, very astute. And then planning ahead. So I mentioned previously that in order to have success in the markets, you need to have a lot of foresight. In order to have good foresight, you need to have good forethought. So planning ahead and thinking about what you're going to do before you actually do it, kind of like Magnus Carlsen does in chess, or Gary Kasparov, or any great chess player, thinking numerous moves ahead. How would I structure a position? Like, let's say, for example, on Aapl, if Aapl pulled back down to 230 area, a great way to structure trades are risk reversals, because typically we don't see declines last very long overall. Again, the stat that I mentioned over the last few weeks was that on average, midterm election years, the average decline is 17.5%. Following that 1 year, 1 year from that decline, we're up about 32%. So knowing this information, knowing that we probably have a pullback of at least 10% this year, and this may be the start of the pullback possibly, how will I position myself? Well, for one, you don't want to be heavily positioned on upside positions as it stands right now, because what happens is that if you're fully allocated and the market pulls back down, let's go back to the S&P chart again, right? SPX. If you were fully allocated back in April of this year on the 1 year chart, and let's say you're fully deployed long here, and we decline 20%. This has a twofold negative effect. The first being that you're down 20% on average, and the second being that you have no capital to actually deploy when things are on sale, right? So you want to have dry powder ready to purchase cheap positions if and when they get to a price that's desirable to you. And by having hedges in place, what you can do is when they come to fruition, you can monetize them.
Hey, what is that? Okay. Okay.
Sorry about that. Carlos just made some noise. So you want to be able to monetize your hedges and then roll those hedges into long positions in names that you like on cheap prices. Now, I've been mentioning Salesforce the past couple of weeks. It is already pretty damn cheap. And if it gets cheaper, I'm going to be very, very enticed to go long with a longer time frame in mind. Again, looking at like the 5 year lows of 126 roughly, I don't think we get there. I think this area right here, the 200 area, is going to be heavy support. So, and it's possible we get there pretty fast if we have a market decline. this would elicit a great opportunity to, for example, sell perhaps the 180 or the 170 or the 160 strike cash secure puts to finance call spreads out of the money. I mentioned a similar play on AMD last summer, and the videos on YouTube, it's on Patrick's YouTube channel. But the idea that I had there was that if you sold the 150 strike put options, and we're actually right over here when this happened, and you use that to finance the 200 to the 300 call spreads for this past Friday, you would have turned a overall debit of less than a dollar into about $35 roughly. So 35x your money overall. Notwithstanding that it's a cash secure put, so your capital is tied up in the form of margin because you're short of put over here. So I love risk reversals because when we decline, what happens? IV inflates, put options increase in value. That makes it more enticing to sell put options at prices you wouldn't mind owning a given asset at. And then using the capital received to convey a long position. So let's go back to an example here, and then I'll kind of take some questions one sec. Back to the options chain. So let's say, for example, on Salesforce, which is already kind of cheap. We're going to go out a few months because we want to have time for our thesis to transpire. Remember, if you're buying too short term, you might miss the move, in which case you have the right idea, just the wrong execution, right? It's important to have the correct execution as well because being wrong on timing makes you wrong overall, right? So let's say, for argument's sake, we go to June, roughly, what is this, five months away or so. And let's say you sold, for example, the 200 strike put option, cash secure put. You receive about $9 and 950 or so, right? You take that capital and you parlay that into, for example, a 250, 300 call spread, right? What happens there? You have an outlay of $3 and change for upside of $47, right? Now, the position moves dynamically, so keep this in mind. And this is a very important way to think about your positioning as you go forward. If and when we push the upside further, this put option will decline in value. At a certain point in time, it's no longer worth it to hold the position. So you might say, you know what, I'm going to close it out, right? If you're a bit more cavalier, you can also sell an at the money put option if you think that we're going to perhaps hover around the current area. So let's say we sold, for example, instead the 220 strike put option here, right? Now you have a credit, roughly, it's not accurate actually, it's around 7 market hours, but if you do the math here, 17 credit less 14-ish plus 4, that ends up being 21 credit minus 14, a credit of $7 overall, roughly, meaning that your break-even point, anything above 213, that being the cash secure put less 7, is profitable to you overall. So anything above 213 by June is profitable overall. And you have upside of an additional $50 on the call spread over here, right? If you pull back down again and this short call option ends up being worth like $2, for example, you'd probably buy that back and pair it with selling an additional cash secure put, perhaps out of the money further, right? You don't need to sell the same strike. A big mistake I see people making is focusing on the same position they're already in. Remember, think dynamically about your positioning. Yeah, so we've covered a lot of different things here already. I'll open up to questions, I guess. What do we have right now for questions? Let's go from the start. So good morning, AJ. How about a long condor or strangle more than taco? The issue is the Supreme Court decision wildcard. Yes, yeah. So that's kind of my thinking is that if the Supreme Court comes out and says, hey, these tariffs are not legitimate, basically we're going to see a reflex action to the upside in certain names. And those names might be, retailers like, for example, or consumer discretionary goods like, for example, Nike or Elf Beauty or like their whole basket of names you can look at. Uh, go back and look and see what was most affected during the tariffs in April, and those names will probably have the most upside overall, right? I like Elf because I've actually traded it and seen how it operates in relation to news out of the market overall, right? So that's one that I actually like a lot. Um, yeah, no worries, no worries, Carlos, not a big deal. This is a very informal session. And then Tony said monetize hedges. Yeah, yeah. So when I say monetize hedges, that means closing the position because at a certain point, remember, one of the things you don't want to do is hedge your position, we decline, and then you don't monetize it. You just leave it on, and then we recover. What was the benefit to you, right? Like that'd be akin to having insurance, for
Sure.
example, like flood insurance on your house. A flood rolls in, destroys your house, you rebuild it, but you don't actually use your insurance for its intended purpose, right? You want to use that insurance when it's available to monetize overall, and you want to use it with the intent that you're using the capital from or the proceeds from that insurance to deploy elsewhere and convey asymmetric upside overall, right? So again, like I love option structures around asymmetry of risk because um, when a market pulls back, you can be deployed, for example, 10% of your portfolio with longs using options where you have a lot of upside. And if we pull back down again, you can then deploy, 40% of your portfolio in risk reversals and an additional like 20% perhaps in long-term leaps. Or I mean, leaps are long-term by nature, obviously. That will express upside longer term, right? Or you can do synthetic longs too, where you sell the out-the-money cash secure put, for example, like we have on Salesforce right here. If you were to do this like a year out, let's look 1 year out on Salesforce, right? If you were to, for example, sell the 230 cash secure put for a year out and then buy this call option as well, what happens here, right? Well, you have a debit, and this is not accurate right here for whatever reason, showing the same number recurringly, but you would have a debit here of about $4 or so, $4 to go long on Salesforce, right? If we push to the upside, let's say we push to like 280 by January of next year, right? Your $4 is now worth $50, right? If we stay in this range, we stay between pretty much, like 210 and 250, you're not losing a hell of a lot overall, right? Like this is kind of a way of thinking about it versus buying the stock itself, especially if it doesn't pay a dividend because you're not getting cash flow at all from the asset. Like there are names you want to own, like UPS or Altria, for example, that have fat dividends for the purpose of generating cash flow, right? But what is your overall objective on your position, right? Is it to achieve a capital gain? Is it to increase your cash flow? Is it to hedge your portfolio, right? You got to ask that question recurrently, right? So next question was, what do you think about Salesforce as having AI risk for long term? Dimitro, like I think Salesforce is so ingrained in most businesses right now, it would be very difficult for AI to replace it overall. Like people are underestimating the lack of preparedness and forethought that companies have had with relation to AI. I know firsthand, my wife works with government clients, financial services clients. They are not prepared at all whatsoever. Like their CTOs and CIOs, they don't know anything about AI predominantly, right? Like they're very, very uninformed. As a result, their teams are not prepared at all whatsoever. So like the lovely idea of buzzwords and like hype around certain products, they try them out for a pilot program for 6 months. There's no ROI. They don't see a path toward ROI. And as a result, what happens? They revert back to what they were using before, right? That's what's probably going to happen, right? Like this, I don't see a path toward heavy usage in the that will in the AI space that will replace Salesforce overall, right? I could be wrong. If I am wrong, though, I think it'll be probably a few years down the road, right? I do have a friend who's high up at Salesforce as well, and he kind of conveys to me that they're very bullish overall internally. So um, Jay said, could go over that Apple play again. I mean, that's been there for 8 weeks. Yes. So Jay, so Apple. Let me pull up the chart again. So Apple's been down a fair bit. And this year we have a bunch of new product releases. They're going to have the new watches. They're going to have some new HomePod with like an iPad attached to it as well for managing the home. Also rumors on Apple security cameras for your house as well. Apple glasses, kind of like the Meta Ray-Bans. So you have a bunch of new product launches, a new form factor design on the MacBook Pro as well. That will probably elicit some new customers to buy because it'll have a touch screen as well as refresh on people that are waiting to refresh it, right? So that's a very, very, I think, key product overall. The iPhone, I mean, it'll keep selling as it sells. Will it be a game changer? They're gonna release a foldable iPhone with like a much larger screen. I mean, I myself don't see the appeal of it. You know, as it stands, I'm trying to get away from my phone, uh, like more and more. So, I wouldn't want a phone that would entice me to use it more, right? But yeah, like areas that I like on Apple right now, if we keep on declining, we break the support area overall. I think 240 would be an area that you can look at, going long, perhaps like building a position. Remember, when you build positions out, like for example, you don't need to build all at once, right? You might allocate, for example, like 5% of your portfolio for a position. You might say, you know what, okay, I'm going to buy some over here first, start a position over here initially, right? Remember, you want to have upside. So doing a cash secured put, that will give you credit on the put side. And if you reverse up, your gains are capped in the form of the credit received. If you want to convey actual asymmetric upside, you need to buy a long position that gives you more upside, right? So you might start over here and say, you know what, I will allocate 1% of my portfolio recurringly as we drop in, for example, perhaps like $5 increments, right? So you might say, I'm going to start at 240 and then go 235 and then go 230 and so on and so forth. And basically, if you did this, one, two, three, four, five times down to 220, right to this area right here, right? What happens there? Well, because you're able to buy more of positions on cheaper prices, your average cost will be somewhere around below 230, which is the middle point of your outlay, right? So you do like 1%, 1%, 1%, 1%, 1%. But because your capital goes further on lower priced options, or perhaps getting more credit on cash secured puts, for example, for risk reversals, you're going to have a better overall average break even price, if you will, right? Which is not really like a good term to use when you're talking about larger or broader structured trades using options. But nonetheless, like your capital that you allocate at 240 is going to go, far less, I guess, efficient than buying at like 220, for example, right? You can buy more of a position at 220 than you can at 240, right? But again, you want to be realistic in your overall expectations. Remember, like analyze how long it takes us to go from a low to a high, right? Analyze how long it takes us to go from a high to a low. These give us clues on how long cycles can last on the overall, like up and down swings we see in certain names, right? Like we see Apple, we have a downswing, small upswing, downswing, fast upswing, right? So we're seeing here that we have, you know, perhaps a little bit longer downswings than we do upswings. So it's possible we drop for another month or so. If that happens, and we're down for, let's say, like, you know, 20 days or something like that, whatever it is, that's probably a good area to go long. Once we consolidate in a range and stop and start sitting in a range like this, great area to go long, right? You don't want to wait for that. I mean, Salesforce right now is not there yet, but it might get there. Let me see. Like we're back down over at the lows. If it consolidates for a little bit, then you want to look for upside, perhaps, right? I think longer term, if you go out, a year, you're going to make money on this trade regardless, right? I don't think we're going to say below $200 or 230 per share. Is there any benefit to, for example, selling an at the money call against a long call position? I had something closing the call or butterflying off a call spread instead of closing the call spread. I mean, if you were selling a call option against another call option, that's called a calendar spread, right? So I'm assuming you're asking if you have a longer term call option, you want to sell a shorter term call option against it, um, or turning into a call spread, perhaps, depending on what your strike price is. There is a benefit, yes. I mean, typically you want to look at the skew on a position and analyze where the volatility is richly priced, and you want to kind of sell. Like for example, let me pull up a different chart here and show you guys what I'm talking about. Analytics. So for Aapl, we have, let me pull this up. I got to June, July, August. Nothing really stands out over here, but for Salesforce, let me see Salesforce. So like an example might be using Salesforce. Again, here's the volatility skew that I'm discussing right now. So we notice that the February OPEX is trading at a richer premium overall. Oh, sorry, this is the March OPEX. It's orange. It's hard to differentiate between the orange and yellow. So the March OPEX is more richly priced overall versus everything else. The February OPEX is priced very, very cheap overall, right? So right now, if you're buying options for February, you're not paying a very high premium overall. If you're buying for, April, May, June, but May here as well, it might be a bit higher perhaps if the earnings before that. Yeah, so they're all pretty much clustered in the same area. So the March OPEX, which would land right after their expiration, I mean after their earnings event, is priced the richest overall. So you might, for example, look at like May long and March short, and then if we didn't get anywhere near your long strike, for example, you would go short April as well. So how would that look on the option chain? Well, if I were to structure a trade on that, I would say, okay, let's look at CRM again. That's what we were analyzing before. I would say, okay, May OPEX, I want to go long here. The IV is 35.4% for May. For March, 37.8%. Again, it'll percolate as we approach the actual earnings event, or if the market declines and we get broad market volatility as well. But the idea here would be that you might say, okay, you know what? I'm going to go long, for example, May, whatever. Could be, well, first analyze the implied move, which is 230. So it's about a $35 implied move by OPEX. Let's call it like a $40 implied move. So upside is 270, downside is 190. I'm leaning upside versus downside, and that doesn't mean we're going to see uh, upside immediately. We might see lower lows before we see some highs, right? But nonetheless, I might say, okay, you know what? I'm going to target the 270 strike. So I do that. I go long 270 for May. Look at March, which has higher relative IV, and I sell 270 for March, for example, right? And if I do that, I have an overall debit. Let me make sure this is correct. So $6 outlay over here, credit received of 3. So you're pretty much paying $3 net. And then what you want is you want us to stay below 270 by March, but above it by May OPEX, right? The closer we get, the better it is for us overall, right? And then if this expires, then you could sell, for example, the April OPEX. If we're near the money, like near 270, you could sell, for example, the 290 or the 300, turn it into a call spread, a call calendar spread. Like there are many ways to kind of iterate around the idea. If you pair it with, for example, a cash you could put for March, in this way, you're kind of pretty much pairing this overall strategy. Like this would be called a short strangle, right? You're short the 270 call and short the $200 put option, right? In this case, now you have a credit of $1.21 when paired with the March 270 call option, right? So basically, now you have upside for May if we push higher, but if we stay pretty much between 200 and 270 by March OPEX, you have a free play on Salesforce for the next 2 months. Kind of beautiful, right? Again, like you want to be able to manage your risk and not over lever in these plays. Like a big mistake people make is like they learn a new strategy and they're like, oh, this is awesome, whatever. I'm going to go in, I'm going to allocate like half my portfolio or a quarter of it, and then they lose and they don't know how to adjust. When I discuss these strategies, I'm talking about outlaying like 1 to 5% maximum in your portfolio, right? No more than that on short duration positions. Let me see any more questions. JR asked, do you have rules of thumb for how far out in time you put the structures? It's mostly based on how fast and slow stock has moved in the past. Yes. So you got to look at what's happened previously because typically each individual equity will move at its own pace. Like AMD, for example, I mentioned last Monday at $200 per share. I was bullish on it. We went up almost 40 bucks in the span of a week. 20% moves up and down in a week time frame are not uncommon on a name like AMD. I mean, Micron has gone up over $100 in the last month roughly, right? So you need to know what you're trading and how fast it moves. Salesforce just fell almost $40 in the last week and a half, right? Which means that when it bottoms out, it could easily recover half of that in about a week and a half to 2 weeks, right? This is the way you got to think about your positioning on on expirations. Like people love going short duration because naturally you can make these crazy, percentage returns. I prefer to be more safe than be more cavalier, right? Like, the idea is to create a process where you have repeatability in your overall decision making, not a one-off where you might, have a nice big home run trade, but how am I going to apply that same decision making process to every decision I'm making for the next few weeks or months, right? You might have a certain setup you look for, which I do as well. Like one setup I love is earning setups where a name that's already cheap, like Salesforce, beats earnings and remains inert after the earning event, right? That causes IB to crush. You have the information in your pocket. You can then go long with confidence, as we saw with the butterfly call spreads I mentioned in my commentary about a month and a half ago, roughly, right? Those calls, butterfly calls went from $2 to a high of $8 before ultimately expiring worthless, right? But the point being is that you're creating asymmetric upside by using structures that are easy to create recurringly in your overall trading patterns. And then an important point there is that you should be documenting all of your decision making, especially if you're newer to trading. Document every decision you make, outline why you made the decision, and analyze your past decisions. If you don't analyze your thought processes and get more introspective, it's hard to improve, right? Very hard to improve. So trade journals are great to use for that purpose. I do have one. If people want one, just DM me. I'll send you my trade journal, and you can just plug in your information there and basically just track like one thing I do is I'll screenshot the option chain on each trade I make, and then at end of day when I have time, I'll look at each option chain, put in the information that I want to plug into my journal, and then I'll look at it later on, and I'll see, okay, like what have I done over the last month, for example, and where have I gone wrong, where have I gone right, and then pretty much you might notice a pattern, like I'm buying too far out of the money, I'm buying too short dated options, I'm not using spreads when I should be using spreads, I'm buying when IB's too high, like many mistakes people make. Okay, Dimitro said experience with CRM was from working at Coin, and in the value Salesforce seemed in the early 2020s hated. Yeah, yeah. I'm not too sure about that. I live in Canada, so our market here is much different overall. I'll go over the last questions and then I'll finish off, guys. I didn't intend for this to be a super long session, but Larry asked, how do you hedge your big long positions for example, Micron, say assuming it's 50%, especially like tomorrow, right? Well, with those, if I'm not already fully allocated and I want to own more, I don't really usually hedge it because again, my view is that I'm not planning to sell this tomorrow or next week. My view is that it's going to $500 to $600 per share by January of next year. And if I'm confident in that belief and there's no information that's material to changing my thesis overall, then on any pullbacks, what I would do is I would sell premium on the put side to take in some premium to offset my overall perhaps like lost profits that I already have, right? Let's say they pull back down to like 280 or 270, and I can sell the 240 or 230 put options, a month out for like $7 or $8, right? I mean, all I'm doing there is just harvesting premium on a name that I actually want to own, right? But again, it's important not to over allocate, and by that I mean having too much of a stock or too many leaps, for example, and then also pairing it with many cash secured puts, because if the market has like the deep correction of like 30 or 40%, which could happen at some point in time, we don't really know. You don't want to be stuck with like one position where you're like 50% of your portfolio in that one position, right? Always manage your risk at all times. This will remove all emotions from your trading decisions. And ultimately, like, we're doing this to make money, to enjoy life. Like the whole purpose of trading is to make money, to enjoy your life, not to be stressed out about it. I know people that trade that take crazy risk and they can't sleep at night and they're always anxious. Like, why? Take less risk, enjoy your life. Life is short. Um, yeah. Yeah. So C. Wagner says cost of Salesforce is astronomical. If I, yeah, it's possible, right? Yeah. So like, yeah, I mean, no, okay. So I see what you're saying. He's saying that once companies buy into it, they can't justify leaving it, which is true. It's a very sticky product. That's my point. Is that like once, like for example, I'm all Mac based, like MacBook Pro, iPhone, whatever. I'm not going to switch to PC or something like that because I'm already part of the ecosystem, right? Once everyone and companies familiar with the products and services of Salesforce, and they've been well trained. Like think about all the investment required to train people up. They aren't going to just be like, hey, we're going to leave and build our own like AI platform that some new company has created that may or may not work and give us, a possible ROI, right? Ripley said, in many ways, Apple is the least risky AI bet. Their services revenues are going to blow up because they own the demand. Yes, that's a good point. I do think that Apple has some decent upside later on this year, perhaps. They are not one of the, well, based on their valuations right now, historically, they're kind of expensive, but let me just analyze one sec. I haven't looked at them in a while, deeply anyway. So yeah, they're about average where they've been valued historically, roughly. Maybe a little bit expensive. Um, I could see them pushing higher, perhaps, but I'm most bullish on Amazon and Google still. I think they have more upside overall. Any thoughts about Meta? Meta plays. I don't really have any thoughts on Meta. I haven't looked at it in a while, but I know it's cheap from a valuation perspective. It's just a matter of they tend to burn a lot of like my problem with Meta is that Zuckerberg, in my opinion, is not a great leader overall. Like if you read the book Empire of AI by Karen Howe, she outlines. Sorry, no, that's a wrong book. It's called what's it called again? Book about Meta. I read it last year. Meta whistleblower. It's called Careless People. If you read that book, which I read last year, the person that wrote it was an insider at Meta. Maybe she's just a disgruntled, perhaps. Regardless, it's very apparent that Zuckerberg is not a great leader overall, right? Um, all of his acquisitions have pretty much been derived from information, almost like insider information on the efficacy of certain apps. Like he knew all about Instagram and WhatsApp and the user bases before anyone else did because they were using a certain app. I forget the name of it. It was in the book, but the point is that he had information that led him to purchase those companies essentially. So he's great at acquiring companies. Anything he builds, like the Facebook phone, uh, internet.org, for example, metaverse, like they all fail, right? So now they're plowing cash into an AI endeavor that may or may not work. I think they're kind of late to the game and they're just going to burn a lot of cash. So that's kind of my concern with Meta is that they make a lot of money, perhaps, but they just burn it all, right? If they had invested in acquisitions, that might have been a better use of capital. They bought half of Scale AI. That's a data annotation company. Like they're not true AI overall, right? Um, yes. So someone just said, yeah, it was a good book. I worked in ad tech for a long time, and it gives that sort of a good perspective on how. Yeah, yeah, Aapl and Zeta. Yeah, yeah. Zeta's interesting. I've heard numerous people ask me about Zeta in the last like month. Like I never even heard of it before this, but everyone's talking about Zeta. That could be an interesting play, perhaps on a pullback. Anyways, guys, I'm tired of talking, but if you have any questions, hit me in chat and I'll reply. Hopefully, was helpful. Again, impromptu. I'll post a recording in chat, and I will see you all tomorrow for our morning meeting. Bye, guys.